Hello, hi, good morning, good evening, good afternoon, good morning to the people in the US, good morning to also the people in Australia, and a very good evening to people in Europe. So today we're going to be discussing about the statement that just come from Federal Reserve. So it's the FOMC statement. So FOMC is a committee in the Federal Reserve responsible for monetary policy. So FOMC stands for Federal Open Market Committee. We will discuss the economic projections that the FOMC committee has come up with for the next 5 years for the US economy. It's very important actually. There are many nuances of it we need to understand, and also in order to be able to understand the regulatory statements, is important to have some understanding of statistics, econometrics, economic forecast, understanding of economic models, forecasting models, statistical models. Some knowledge of statistics is very important. You will understand what is a point estimation, what is a interval estimation. So a lot of that is important to understand. So if you are a student of economics or finance and you have seen economic models or financial models, you know that when you forecast for the future, you first you go with a lot of assumptions. So those assumptions also should be clearly specified, and you need to understand the forecast has been made under these assumptions. So some assumptions are made, so that understanding is very important. And there are some loopholes in the modeling techniques also. Okay, so understanding those loopholes is also important. All that is taken into account in the uncertainty related to forecasting, and that is quantified in interval forecast. Okay, so what is interval forecast? Is nothing but having a lower bound and upper bound for the forecast. Okay, so for instance, if you are forecasting that next year the inflation will be 5%, you have a lower bound and an upper bound to that. So lower bound could be 3%, upper bound is about 6%. So you could say that the inflation will be 5%, but it could lie between 3 to 6%. Okay, so the later will be known as interval estimation. Okay, in statistics that's what is called. So understanding of some statistics is very, very important, therefore, to understand any policy statement related to monetary policy. Okay, and most of these people who are working on this are economists. So understanding of economic models therefore is so important. I think the most important news for today is that Fed has issued a statement that it is increasing the interest rate further. It has already done that earlier this year, but it is doing that again. It has increased the interest rate by 0.75 percentage point. So that increase has been announced. So that will have some repercussions, some impact on the real economy, right? Including the stock markets and whatnot, right? I'm sure there is already some impact in the stock markets in the US, but some of the stock markets, for example, in Asia and Europe right now are closed. They will be starting tomorrow in the morning, and you will also see some impact there. But this is not unexpected. I think people knew this, that Fed is going to increase the interest rate not just now but also in the future, in the near future. For example, by end of this year, it is expected that the interest rate will be increased further by 1 percentage point. So that will take it to about 4.25 to 4.5 percentage interest rate. which is quite actually massive change compared to what it was a couple of months back. Okay, so I was going through this news item on Yahoo Finance, where it's a bit of a it's a summary of the speech given by the head of Fed, and we can go through it also. So it says that the interest rate has increased by 0.75 percentage point to tame inflation, and I think Fed officials predict that the key rate will end 2020 at a range of 4.25% to 4.5%. That's what I was talking about, which is a massive increase compared to what it was a couple of months back. And I think in the speech, it has not been made very clear as to whether this will be done in the future, but it is quite expected. Okay, so it is not a surprise, won't be a surprise if this happens in few months' time. Okay, maybe we can spend a couple of minutes to understand how this announcement was made and what it happens, but obviously the topic will be more on this particular report that has been published on Fed's website, which is about economic projections for the next 5 years. So in June this year there was this projection, but now in September they have come up with a revised version of that projections, and they're very important points to note. But maybe let's spend a couple of minutes maybe listening to the announcement that was made today, I think an hour back or so.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
That's
we have
the
both
target
the tools
percent.
we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate.
Oh, nay.
Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
The boys are back in town. Boys are back in town.
All right, I think the Fed chief has touched upon all the important economic factors such as the inflation, the interest rate, the unemployment rate, as well as house price and house price index, job market, everything. The job market is actually doing well. There are more vacancies than there are people willing to get those jobs. So that's a good thing. Inflation is high, is the highest in the last 4 decades in the US economy. Housing prices were increasing for a long time, for some time now, but it has cooled down. And I think, because of the higher interest rate now, not many people are willing to buy houses at the moment. So, these are some of the changes. So these are obvious things actually, we already know them. But I think what is interesting in this report is about the forecast that has been made for the next 5 years. In a more shorter run, we know what is going to happen in the next 3 months. For example, inflation will continue to be there, interest rate will be continue to be very high. Housing market will be in trouble for good reason, because the interest rate, the mortgage rate is now quite high. Employment rate will continue to be low, and there will be more jobs in the market despite the problems in the economy. There's going to be a lot of jobs in the market because we are coming out of pandemic, so that's quite obvious. But what's important is what's going to happen in a year time or 2 years time. So that prediction is something that Fed has done, and here you see this table where you have the change in real GDP, change in unemployment rate, inflation rate, and you have a median, and you also have central tendency and the range. I was talking about point estimation, interval estimation in economic forecast. So point estimation is about just single value. For example, here in this case you see so the forecast for 2020 is that the GDP growth rate will be 0.2%, and in 23 it's going to be 1.2%, and in 24 it's going to be 1.7%. So that's point estimate, whereas the interval estimate is more of a range. So here you see for 2022 the range is 0 to 0.5%. okay. Similarly for 2023 the range is negative 0.3% to 1.9%, and for 2024 it's 1 to 2.6%. so that's interval estimation, or in interest estimation we normally get this range. Okay, we get a lower bound and upper bound. There are also some beautiful graphs actually, so good to actually look at these graphs. I think in the presentation that the Fed chief was making, there also he used these graphs. So here is the GDP. So we see the GDP growth for the last few years. It was about somewhere around 2 to 3%, but in 2022 it was negative. And here you see it is gradually growing, like from 2022 to 2025, from 0.2% to somewhere around 2.5% by 2025. So that's longer run forecast. And these are box plots. Okay, so if you are an economist or statistician or data scientist, you must already be knowing that these are box plots where you have a median value, and then you have the upper range and the lower upper bound and the lower bound, or the range. Okay, so that's these are not the interval estimates, by the way. Okay, so these are basically the 75th and the 25th. Okay, here is the 50th percentile, so the median one, but the upper, this part is 75th and this part, lower part, is 25th percentile. Similarly, you see the unemployment rate, it is quite low now, 4% is, and it is going to be higher next year, somewhere around 4.5%, but it will remain stable actually. It continue to be low for the next few years. And then you have inflation, it is quite high at the moment, almost touching 8 to 9%. And what is expected is that because of these measures that Fed is currently taking, which is about raising the interest rate, the inflation rate is expected to go down to about 4%, but the target is 2%, and that target will be achieved by 2025. So it's going to take 4 years to achieve that, but nobody knows for sure what is going to happen in the future, right? And in fact, that's exactly something Jerome Powell was saying in his speech, that nobody knows actually what's going to happen, but this is based on the data, based on the expertise that Fed has and has used in order to get to these numbers, expected numbers for the future. So here is the target range for the federal fund rate. So federal fund rate, nothing but the interest rate, okay, borrowing rate, okay. So that's going to be, this year it is going to be somewhere about 4.5%. It is going to go higher actually next year, so that's like bit higher, and it is going to be somewhat lower, more lower, and even more lower in 25. So gradually it is going to come down over the period of time, okay. But note one thing here, that for short term forecast the range is small. Like for 2022 we almost know for sure where the range will lie. For 2023 we are a bit more confident about the range, so the range is therefore somewhat not a very big range, right? Whereas for the subsequent years you see the range is quite is a somewhat bigger range, because uncertainties, right? For longer term forecast it's very difficult to predict these numbers actually. So hence the range is quite high, okay. So it could lie anywhere between 4.5% to 2.5%. So that's a very large range. Whereas for 2023, the Fed is fairly confident it's going to lie between 4 and 5. Okay, so longer term forecasting is therefore very, very difficult in statistical forecasting or economic forecasting. Then you have distribution of GDP and about so they have also used bit of a voting mechanism. That means there are many forecasters within Fed, and many people have come up with different forecasts. So they have also done a plotting. Here you see the GDP forecast for 2022 be anywhere between. So it's like some majority are saying it's going to be 0.2%, but there are also some fraction of people saying it could be 0%, it could be 4.4%. Whereas for next year's 2023 and 2024-5, you see the variation is actually quite large. That means there is hardly any consensus within the group of economists working for Fed that what is going to be the GDP for 2023 and onwards, 24 and 25. So longer term forecasts are so very difficult actually. Nobody can properly predict, but based on the economic models Fed is using, we can sense that in 2023 it will be somewhere between 1 to 3%, and it's going to be more stable, like close to 2%, 2.5% in 2024 and 5. Similarly, unemployment rate, I think there is a bit more confidence on unemployment rate, that it is still, despite the rate hikes, despite the high inflation, despite the issues in the housing market, despite the war, commodity prices being high, export being low because the outside economy is not very strong, like all these points were mentioned in the speech that we should listen to. Despite all this, the unemployment rate is still going to be quite stable. So that's something is Fed economists are more confident about. Right, and then you have inflations. Again, more confidence on this forecast that inflation is going to stay at least for 2 years, but after, because inflation is something where the Federal Reserve has control, right? For unemployment rate, for other aspects of economy, Fed has barely any control. Actually, a lot of things will also depend on fiscal policies by the government, outside economy, like the international more world economy. So all that will matter. Whereas for controlling the inflation, actually Fed has better ammunitions for that. So therefore Fed is more confident that in 2 years time the 2% inflation rate will be achieved. 2% in 2024. Okay, there's more information, and here you see the interval estimation. I was talking about the interval estimation. Here you see, right? So this red is the point estimate, but you also see the interval, and for the further in the future you want to make a forecast, the range will be higher, right? Therefore you see it's a bit narrower in 2022, it's the opposite in 2025, right? So that's quite obvious actually, right? More years in the future, more uncertainty are there, so you have less confidence on your forecast, so hence the range in the interval estimation is quite therefore large. Yeah, there are also uncertainty with GDP forecast, right? And I think the Fed chief also mentioned this, that nobody can actually properly predict, but all you can do is that use the best models at your disposal and predict the future. So these are estimation, right, based on the information that you have right now. So conditional estimation, technically speaking, but this could also change. Similarly, you have this is interval estimation for unemployment rate. Then more technical details such as predicting the error rate. Okay, so this is more important interest to economists actually, but as a normal person I think you don't really bother about that. Then you have diffusion. Okay, so diffusion is more of a dispersion. It's about variations, so participants, as in whoever actually participated in the policy formulation, so there is a bit of a variation in their opinion, and here is more of a variations they have projected, and the variation is actually quite high because of uncertainties. Okay, not just for GDP but for all forecast you have, and normally in very uncertain scenarios this diffusion index is actually very high. So as you can see also this, and if you draw a parallel, right, here you see that this is an issue right now, but this used to be also quite high during 2007 to 2010, that period. This financial crisis, the 2008 subprime crisis, during that time also it was quite high. Okay, all right, so so we learned a bit about how to read the monetary policy statements. You can obviously always listen to the speech given by the head of Fed or head of the monetary policy department, but you can also read the statement. It's a bit more technical if you go through this this document, but if you really want to understand in depth, understand the different nuances of economic forecast, I think better to go through these papers. The speech is more at a high level, more for general audience. Okay, and if you want to report, this is at the nutshell. Sorry, this is the gist of the entire document. Okay, change in the real GDP, plus minus, and also the forecast. So this table is the most important one in this document. All right. So thanks for today. Thanks for joining it, and I will see you tomorrow. Thank you.